There are some topics that just sound really dense, like they require a decoder ring and maybe a law degree just to get started.
Oh, yeah, like quantum physics or trying to read ancient scrolls.
Exactly. And tax law, it
Yeah.
often gets lumped right in there. But what if we told you that hidden inside all that legalese, there are actually fascinating stories, some surprising twists?
And really crucial insights that can, save you a lot of headaches, maybe even some actual money.
That's the idea. It's not just about numbers on a page.
Absolutely. It's about how courts interpret rules, the sort of push and pull between the government and taxpayers.
And how these decisions, even the small ones, really shape your financial world.
It's a real look at how things work on the ground.
And that's exactly our mission today. We're doing a deep dive into a fresh stack of recent tax rulings and administrative guidelines, all from the Philippines.
And our sources are straight from the top right: Supreme Court, Court of Tax Appeals.
Yep. And key stuff from the Bureau of Internal Revenue, the BIR. The goal here is to pull out those vital nuggets of knowledge, help you navigate this complex world with a bit more clarity, maybe more confidence too.
Get ready for some aha moments, hopefully.
Let's hope so.
Ah,
So where should we start? Maybe something a lot of businesses run into.
okay, yeah. Let's kick things off with overpayments. What happens when a corporation pays too much income tax?
Right, okay. So they have two main options, basically.
Two paths, yeah.
They can ask for a refund, get cash back, or get a tax credit certificate, a TCC, to use later, or they can choose to just carry over that overpayment, use it to offset taxes in the next quarters. Seems simple enough, right?
It does sound simple. But here's where it gets interesting and frankly where people get tripped up. There's this thing called the irrevocability rule.
Ah, yes, the irrevocability rule.
And this is the key part, and it only applies to one of those options.
Wait, really? Not both? So it's not like once you choose, you're locked in either way.
No. And this is huge for flexibility. If your business initially asks for that refund or the TCC, the law doesn't actually stop you from changing your mind later and switching to the carryover option.
Wow, okay. That's actually quite significant. Gives you room to adjust.
Exactly. That flexibility has been made pretty clear in recent Supreme Court rulings. There was one involving University Physician Services back in 2018, and it popped up again in 2023.
So that choice isn't set in stone. Good to know.
But, and here's the kicker, the part that is critical, the reverse isn't true.
Ah, okay. So if you choose the carryover first.
Once you choose to carry over that excess tax credit, you are locked in. You cannot then switch back and ask for a cash refund or a TCC.
Yeah.
That part is irrevocable. The law is very explicit there.
Got it. So choose carryover, and that's your path. That distinction alone could save or cost a lot, depending on if you know it.
Definitely.
And speaking of critical things, deadlines. Tax law seems built on deadlines.
Oh, absolutely. Miss a deadline and you could be out of luck.
So what's the general rule for claiming refunds or credits, say, for taxes paid by mistake?
For almost all those administrative and judicial claims asking the BIR or the courts for your money back because it was wrongly collected, you've got 2 years.
2 years from when?
From the date you actually paid the tax. This is pretty universal. We saw it recently in a 2024 case about an estate tax refund. 2 years, that's your window.
Okay, 2 years generally. But I feel like VAT is always a special case.
You're right, it is. For unutilized input VAT refunds, there's a more specific and sometimes confusing timetable. People call it the 120 plus 30-day rule.
120 plus 30. Okay, break that down.
So the Commissioner of Internal Revenue, the CIR, gets 120 days.
From when?
From the day you submit all your complete documents for the VAT refund claim, they have 120 days to decide.
And if they don't decide? Or if they deny it?
Right. If the 120 days pass and they haven't acted, or if they deny the claim within that period, then your clock starts ticking. You have exactly 30 days to file your appeal with the Court of Tax Appeals, the CTA.
And that 120-day period for the CIR to decide, is that like a guideline? Or is it firm?
It's firm, it's mandatory and jurisdictional. That means if you file your court appeal too early or too late relative to that 120-day period, the court might just throw out your case. The IHE case really cemented this.
Wow, okay. Strict timing. Now, with this 120 plus 30 rule being so strict, was there ever a time it was different? I kind of remember hearing about a window where you could go to the CTA earlier.
You're spot on. Yes, there was a specific period. It ran from December 10th, 2003 up until October 6, 2010.
Okay.
During that time, a particular BIR ruling, number DA 48903, actually allowed taxpayers to file their judicial claims with the CTA even before the CIR's 120-day period was up.
So the BIR's own rule contradicted the later understanding of the law.
Pretty much. And the Supreme Court later recognized this situation. They called it equitable estoppel.
Equitable estoppel, meaning?
Essentially, the government, through the BIR's ruling, had misled taxpayers. So it wouldn't be fair to penalize those taxpayers for following the BIR's own guidance at the time, even if that guidance was later found to be, well, wrong.
That makes sense. It highlights how important clear and consistent rules from the government are.
Absolutely. A 2017 ruling involving CE Luzon Geothermal Power Company specifically addressed this exception.
Okay, so we've got the deadlines, the exceptions. What about the paperwork? You mentioned complete documents for the VAT refund. How critical is documentation overall?
It's everything. Seriously, for any refund claim, VAT or otherwise, you have to prove you're entitled to it, not just, under the law in theory, but by providing every single piece of required evidence, all the documents. If your first claim, the administrative one you file with the BIR, gets denied because you failed to submit everything they asked for.
Then what?
Then your judicial claim, your appeal to the courts, is likely dead on arrival too. The courts will say you didn't exhaust your administrative remedies properly. We saw this clearly in a 2022 CTA ruling. Documentation is your foundation.
Got it. Paper trail is king. Now, what about businesses dealing with both VTable and V8 exempt sales? Like they sell some things with VT, some without. How does the input tax credit work then?
Yeah, that's common. For those mixed transactions, if you have input tax, the VAT you paid on your own purchases that you can't directly link to either a taxable sale or an exempt sale.
Right, like overhead costs maybe.
Exactly. That unattributable input tax have to be prorated, split proportionally. And you can only claim the portion that corresponds to your VAT taxable sales as an input tax credit. It's all about proper allocation.
Makes sense. Precision matters there. Okay, so we've talked about getting money back. Let's flip it. What about when the BIR says you owe them money? Tax assessments.
Yes, the other side of the coin. And assessments can be even more complex, you're right. Due process is absolutely paramount here.
And it starts with something pretty fundamental, right? The void assessment rule.
Correct. This is a bedrock principle. A taxpayer must be informed in writing of two things: the law and the facts that the assessment is based on.
Both the law and the facts.
Both. If they fail to provide that clear basis in writing, the assessment itself is void. Kaput. Like it never happened. This isn't new. It's been upheld consistently for years. 2018, 2021, 2023 rulings all confirm this.
Okay, so you need the why and the what. Let's unpack that a bit more. A huge piece of this due process, especially during audits, is the letter of authority, right? The LOA.
Oh, the LOA is crucial. Think of it as the official warrant for the tax audit. It's the document that grants a specific revenue officer the power to examine your books.
And who issues it?
It has to be issued by the Revenue Regional Director or the Commissioner of Internal Revenue themselves. Proper authority is key.
Okay, but what happens if, say, an audit starts with one officer and then it gets handed over to someone else?
Excellent question. This is where it gets really specific and where assessments often fail. If that audit is reassigned or transferred to new revenue officers, a new LOA, or at least an amended LOA naming the new officers, must be issued.
You can't just hand off the old one.
Nope. Failure to issue that valid, updated LOA naming the specific officers conducting the examination renders the entire resulting deficiency tax assessment null and void.
Wow. So even if you technically owe the tax?
Even if the amount is correct, if the officers who examined your books weren't properly authorized by a valid LOA specifically naming them, the assessment they issue has no legal leg to stand on. The tax authority has simply lacked the authority to make that assessment.
That's huge. Where have we seen this emphasized?
It's been a consistent point in recent Supreme Court cases. A major one was just in 2024, Commissioner of Internal Revenue versus McDonald's Philippines Realty Corp., and it's echoed in tons of CTA rulings from 2022 and 2024 as well. The LOA validity is non-negotiable for a valid assessment.
So a flawed LOA can just torpedo the whole thing. That's a massive protection for taxpayers. But does that mean the tax liability just disappears forever?
Not necessarily the liability itself. The assessment is void because of the procedural defect. The BIR might still be able to come back.
How?
By doing it properly the second time around, issuing a valid LOA, conducting the examination correctly, and then issuing a new assessment if they're still within the prescriptive period.
Ah, right. Prescription periods. How long does the BIR generally have to assess taxes?
The general rule is 3 years.
3 years from?
From the last day the law requires you to file the return, or from the date you actually filed if you filed late. whichever is later.
Okay, 3 years. That seems manageable.
Yeah.
But I bet there are exceptions. Longer periods for serious stuff.
You bet. The period jumps to 10 years in two main situations. If you filed a false or fraudulent return with the intent to evade tax, or if you just completely failed to file a return at all.
10 years. And when does that 10-year clock start?
It starts from the date the BIR discovers the falsity, the fraud, or the omission, not from the original filing date. A 2024 source clarified that, so serious violations have a much longer reach back.
That 10-year window is definitely something to be aware of. Okay, let's shift gears slightly. Local taxes, like real property tax. Protesting those assessments, do you always have to pay first? Pay under protest.
Good question, because the rules aren't the same for all taxes. For real property tax assessments issued by local government units, yes, payment under protest is required before they'll even consider your protest.
Okay, so for property tax, pay first, protest later.
Essentially, yes. But, and this is the important distinction for claims for refund or credit of national taxes that were erroneously or illegally collected, like income tax or VAT, payment under protest is not required. You can file your refund claim without having paid under protest first. A 2018 source made that clear. So you really need to know which tax you're dealing with.
That's a vital difference. Okay, what about tax abatement? That's when you ask the BIR to basically forgive or reduce your tax liability, right?
Correct. Maybe due to unreasonable assessment costs or hardship.
How do you know if your application for abatement is actually approved?
It's only considered officially approved when the BIR issues a specific termination letter. Until you have that letter in hand, it's not done. That was clarified in a 2017 source.
And is the BIR's decision on abatement final? Can they just say no and that's it?
Well, the commissioner does have discretionary power to abate taxes, but that power is not absolute. Meaning it can be challenged. The CIR's decision on abatement is subject to judicial review by the Court of Tax Appeals. If the taxpayer believes there was a grave abuse of discretion, like the denial was completely arbitrary or unreasonable, they can take it to the CTA. That's a key check and balance, highlighted in a 2024 source.
Good to know there's recourse. It really feels like the courts play a huge role in making sure the tax system is fair.
They absolutely do. They're the ultimate arbiters of interpretation.
Okay, let's dive into some specific scenarios now. Exemptions, special cases. Who pays, who doesn't?
Sounds good. Let's start again with real property tax exemptions. Who gets a pass?
Government property, usually.
Generally, yes. Properties owned by the Republic of the Philippines or its political subdivisions, provinces, cities, municipalities are exempt. But there's a big unless. Unless the beneficial use of that property has been granted for a fee to a taxable person or entity. So if the government owns land but leases it out to a private company, that company might have to pay the property tax.
Okay, that makes sense. What about government agencies like, say, the Airport Authority? MIAA.
Right. Instrumentalities of the national government, like MIAA. They are exempt from real property tax, specifically for lands and buildings that are considered properties of public dominion, meaning they're intended for public use. That principle comes from 2015 and 2016 sources.
And what about cooperatives? They often get tax breaks. Does it include property tax?
They do get breaks, and yes, they are generally exempt from real property tax. But, similar to the government property rule, there's a condition.
Which is?
The exemption only applies when the cooperative itself actually directly and exclusively uses and possesses the properties. If they're renting it out to non-members, for example, the exemption might not apply to that portion. A 2016 source clarified this use requirement.
Okay, exclusivity is key there. Now, here's one that I think might surprise people. Condominium corporations. I always thought the association dues and fees they collect were just held in trust for the residents, not income.
That was the prevailing interpretation for a long time. People saw it as just pooling funds for common expenses.
Right, but that changed.
Big time. Starting in 2022, the Supreme Court issued a major ruling. It clarified that association dues, membership fees, and other similar assessments collected by a condominium corporation do constitute income and are subject to income tax.
Wow. So that merely held in trust idea is gone.
Explicitly abandoned by the Supreme Court in that decision. It's a significant shift.
Definitely. Does that mean condo corps pay all sorts of taxes now?
Yeah.
Like local business tax, too?
Well, there's a bit of nuance there. While they pay income tax on those dues now, a 2024 CTA ruling clarified that they are generally exempt from local business tax, as long as their activities stick strictly to what's allowed under the condominium code, basically, managing the condo building and common areas for the owners. If they start engaging in other business activities, that could change.
Okay, so income tax, yes. Local business tax, generally no, if they stick to their core function. That's quite the update. I bet that caught a lot of condo boards off guard.
I imagine so. It really highlights how interpretations can evolve.
It makes you wonder what other seemingly settled areas have these kinds of twists, like excise taxes.
Yeah.
Cigarettes, for example, seem straightforward. Tax per pack.
Mostly, yes. But there was a specific issue about packaging. The excise tax on machine-packed cigarettes is levied on the standard 20-stick pack as a whole. The BIR tried, through regulations, to impose an additional tax liability if cigarettes were sold in smaller pouches, like packs of 5 or 10 sticks, arguing each pouch was a separate taxable unit.
10.
The court struck that down back in 2013. They said the BIR regulations were essentially trying to create a new tax not specified in the law, which is beyond their power. The tax is on the 20-stick equivalent.
So the BIR can't just invent new taxable units through regulations.
Exactly. And on excise tax, just last year, 2023, there was another case ordering a refund for excise taxes that were wrongly paid on imported alkylate. So errors happen and refunds are possible.
Good to know. Let's switch to income tax specifics again. Minimum wage earners, MWEs. This affects a lot of people. What about things like holiday pay, overtime, night shift pay? Are those taxed for MWEs?
This is really important for worker protection. For someone classified as an MWE, their holiday pay, overtime pay, night shift differential, and hazard pay are all exempt from income tax.
All exempt. Okay, but what if they earn a little extra, like commissions or maybe some small fringe benefits? Does that kick them out of the MWE category altogether?
That's a key question, and the answer is no, it doesn't necessarily. An MWE who receives additional compensation commissions, honoraria, fringe benefits, even if those extras go over the threshold, like the P30,000 back then, now P90,000 de minimis benefits threshold potentially factors in.
Right.
They do not automatically lose their MWE exemption status for their minimum wage earnings. Only the additional income, the amount above their statutory minimum wage and exemptions, gets subjected to the appropriate tax.
So the minimum wage portion stays exempt.
Exactly. It shows a pretty liberal interpretation of the law, RA 9504, aimed at protecting the core earnings of minimum wage workers. A 2017 source confirmed this approach.
That's really helpful clarification. What about government debt instruments? Any interesting rulings there?
Yes, there was a bit of a saga. Back in 2011, the BIR issued a ruling that basically declared all government debt instruments to be deposit substitutes.
Regardless of how many lenders there were, what about the 20-lender rule?
Exactly. The ruling ignored the established 20-lender rule, which is a key test to determine if a debt instrument should be treated as a deposit substitute for tax purposes.
So what happened?
Eventually, the court stepped in. That 2011 BIR ruling was deemed ultra vires Latin for beyond its powers. The BIR had overstepped its authority by effectively changing the definition in the law.
And could they apply it retroactively?
No. The court said applying it retroactively would violate the non-impairment of contracts clause in the Constitution. People had entered into these debt agreements based on the rules at the time. A 2015 source covered this.
Okay, interesting jurisdictional battle there. Let's round out this section with VAT. PADCOR, the gaming agency. How are they taxed?
PADCOR's situation is unique. Their income strictly from gaming operations is subject only to a 5% franchise tax.
Only 5%.
Yes, and crucially, that 5% is in lieu of all other taxes. So no income tax, no VAT on that specific gaming revenue.
But what about other things they do? Don't they manage properties or other services?
Correct. And income from those other related services, things outside direct gaming operations, is subject to regular corporate income tax and potentially other taxes like VAT. That distinction between gaming and non-gaming income is key, highlighted in 2016 and 2023 CTA rulings.
Got it. Two separate buckets of income taxed differently. Now, what about VAT zero rating for services to international carriers, like hotels providing rooms for airline crews?
Right, this comes up often. Services that VAT-registered businesses provide to entities engaged in international shipping or air transport, like hotel rooms, food, beverages for pilots and crew during layovers, can qualify for VAT zero rating.
Can qualify, meaning it's not automatic.
Exactly. The zero rating applies only to the portion of those services that will actually be used in their international operations. It's not a blanket zero rating for everything you sell to an international airline. For example, services consumed purely domestically might not qualify. A 2024 source emphasized this need for allocation or proof of connection to international operations. Specificity matters.
Okay, so you need to link the service to the international aspect. Lastly, for this part, renewable energy developers, RE developers. Any special VAT treatment or incentives?
Yes, there are incentives under the RE Act. If someone buys RE equipment solar panels for their home, for instance, for residential, industrial, or community use, they might be entitled to a rebate.
A rebate of what?
Equivalent to the VAT that was passed on to them when they bought the equipment. This rebate comes as a tax credit against their income tax liability.
An income tax credit, not a VAT refund.
Right, but there's a catch. This specific rebate is only available if the purchaser is not VAT registered themselves.
Okay, and can they stack incentives, like get benefits under the RE Act and other tax code incentives?
Generally, no. The principle is usually that availing incentives under a special law like the RE Act disqualifies you from claiming other similar tax incentives under the General National Internal Revenue Code for the same activity. It's to prevent double dipping. A 2022 source laid this out.
Makes sense. Prevent getting the same benefit twice. Wow, we've covered a lot of ground on specific cases.
We have, and a clear theme, as you said, is this interplay between the tax agencies and the courts.
Absolutely. Which leads us perfectly into our next big topic, the power of interpretation. Who really gets the final say? The agency writing the rules or the court reviewing them?
This is such a fundamental point. Many people think that because the BIR issues revenue memorandum circulars, RMCs, or revenue regulations, RRs, those are the absolute final word.
They are the official interpretations.
They are administrative rulings, yes, and they interpret the tax laws. They definitely deserve respect, and they guide taxpayers and BIR personnel. But, and this is a big but, they are not conclusive.
Not conclusive.
Meaning a court can find them to be wrong. If a court judicially determines that an RMC or RR is erroneous or that it goes against the actual law, the court can effectively ignore it or strike it down.
So the BIR can't just expand or change the law through its own rulings.
Exactly. Administrative rulings cannot enlarge, alter, restrict, or go beyond the provisions of the law they're supposed to administer. They only interpret. They don't legislate. We saw an example where part of RMC 23/2014 was invalidated because it wrongly tried to make certain local officials withholding agents, something not supported by the tax code itself.
So the law passed by Congress is supreme, and the BIR's interpretation has to align with it. That's a critical check.
Absolutely.
What about applying these rulings backwards? Can the BIR issue a new interpretation today and apply it to tax situations from 5 years ago? Retroactivity.
Generally, the rule is no. Administrative rulings cannot be applied retroactively if doing so would prejudice the taxpayer, basically, if it harms you based on rules you didn't know about when you acted.
Generally, no. So there are exceptions.
There are. The main ones are, if the taxpayer deliberately misstated or omitted facts when they perhaps got an earlier ruling, if the facts changed significantly later, or if the taxpayer acted in bad faith. And there's also that equitable estoppel idea we touched on earlier. If the BIR's own actions somehow misled taxpayers, they might be prevented from applying a new, harsher rule retroactively. But the general principle is no retroactivity if it harms the taxpayer who relied on the old rule in good faith. 2017 and 2024 sources support this.
This feels connected to that legal principle, verba legis,
Yeah.
the plain meaning rule.
Exactly. Verba legis non est recidendum, a cardinal rule of statutory construction. If the law itself is clear, plain, and unambiguous,
Then what?
then there's no room for interpretation or construction. You just apply the law literally as it's written. You don't try to read things into it or look for hidden meanings. This was reiterated in a 2023 source. It emphasizes that even the CIR's interpretation power doesn't allow them to override, supplant, or modify the clear words of the law itself.
The law means what it says.
When it's clear, yes.
Okay, now what about the highest court? What happens if the Supreme Court changes its mind? Like overrules an old decision or doctrine and comes up with a new interpretation. Does that new interpretation apply retroactively to cases decided under the old rule?
That's a great question about judicial decisions. Generally, when the Supreme Court overrules an old doctrine and adopts a new view, the new doctrine is applied prospectively.
Prospectively. meaning only going forward.
Yes. It applies to cases arising after the new decision, but typically not backward to invalidate actions or decisions made in good faith based on the old established doctrine.
Why is that?
It's about fairness and stability. It protects parties who relied on the old rule when they made decisions or took actions. Changing the rules retroactively based on a new court interpretation could create chaos and unfairness. A 2025 source touches on this principle of prospectivity for overruled judicial doctrines.
That makes a lot of sense. Predictability is important in the law. Okay, so we have these complex laws, interpretations constantly being debated and refined. How is the tax administration itself trying to keep up? Modernize things, especially with technology.
That's definitely a major push. The BIR is increasingly emphasizing, and in many cases requiring, the use of its digital platforms.
Like the EFPS.
Exactly. The Electronic Filing and Payment System, EFPS, and the EBIR forms package. The goal is to move tax compliance online as much as possible. A 2021 RMC highlighted this continued push.
What about signatures? Do we still need wet ink on paper, or are e-signatures okay now?
That's been a significant move. Electronic signatures are now officially recognized for BIR forms.
Really, across the board.
It aligns with the Electronic Commerce Act of 2000. It provides a clear legal framework for using e-signatures to authenticate tax documents. Another 2021 RMC confirmed this, which is a big step for efficiency and convenience. No more printing everything just for a signature sometimes.
Definitely a welcome change. I've also heard buzz about mandatory e-receipts or e-invoicing.
Yes, that's rolling out. More and more taxpayers, especially larger ones or those in certain sectors, are being required to issue electronic receipts or invoices instead of paper ones.
And how does that work?
They need to develop systems, often based on Standard Application Programming Interface, API guidelines provided by the BIR, to issue these e-receipts and transmit the sales data electronically, often in near real time, to the BIR. A 2022 revenue regulation lays out the framework for this. It's about better monitoring and data collection for the BIR.
So more data flowing electronically. And any other digital shifts? What about specific benefits, like for retirement savings?
Yeah, even specific incentives are going digital. Take the Personal Equity and Retirement Account, or PERA. There's a 5% tax credit on qualified contributions.
Right. How'd you claim that?
The application for the PRA tax credit certificate, the TCC representing that 5% credit, is now filed entirely online through the BIR's PRC's platform. A 2021 RR mandated this. So it really shows the trend moving processes online for efficiency, even for claiming specific tax breaks.
Wow. Okay, what a journey through the tax landscape. We've really gone from the basics of refunds and assessments through all sorts of specific exemptions, property tax, MWEs, PADCOR, and landed on this crucial power dynamic between the agencies and the courts.
And hopefully listeners now have some really specific takeaways, like how that irrevocability rule for refunds actually works only locking you in one way.
Right, and the absolute non-negotiable importance of a valid letter of authority for any audit. That's huge.
And remembering that even official BIR rulings aren't the absolute final word if they conflict with the law itself. The courts have the power to review.
Understanding these details, these nuances. It's not just for tax pros, is it?
Not at all. It's empowering for anyone making financial decisions. Whether you run a business, work for one, or just manage your own finances. Knowing these things gives you a real edge. You're moving beyond just surface-level understanding.
You're genuinely well-informed. So thinking about all this constant change, evolving laws, new court interpretations, this big push towards digital, it makes you wonder, doesn't it? What's next?
It definitely does.
Here's a thought for you to chew on. With technology like artificial intelligence getting more sophisticated, how might the future of tax compliance change? Could AI move beyond just helping file returns and actually provide real-time, personalized guidance based on your specific situation and the latest rulings?
Imagine AI helping navigate disputes, ensuring interpretations are applied consistently.
Could it potentially transform how we interact with the tax system entirely? Maybe even lead to greater fairness and equity for taxpayers like you?
It's a fascinating possibility, something to definitely think about.
Indeed. Something to ponder until our next deep